Breaking news! Nissan has just detonated a bombshell across the US auto market, and the shockwaves are already shaking dealerships, Wall Street, and every major automaker watching from the sidelines. Nissan's decision to slash prices on some models by thousands of dollars isn't just another seasonal discount. This is a strategic move born out of pressure, desperation, and a rapidly shifting market environment. And tonight, we're breaking down exactly why this is happening, what it means for the auto industry, how investors are reacting, and whether you should take advantage of these deals before they disappear. Right now, the biggest question everyone is asking is simple: why is Nissan suddenly giving such massive discounts? The answer goes deeper than slow sales. Nissan has been struggling with inventory buildup after production finally normalized post-pandemic. Demand hasn't kept pace, especially for sedans and older SUV models. On top of that, high interest rates crushed car affordability in 2024 and early 2025, leaving Nissan dealerships stuck with vehicles they can't move. Internally, Nissan knows it cannot afford to lose more market share to Toyota, Hyundai, and Honda. So instead of waiting for demand to magically return, they're firing the only big weapon they have: price drops. Dramatic, aggressive, and fast. But here's where things get intense. What does this mean for the US auto industry as a whole? For years, automakers tried to avoid huge discounts because it devalued brands and cut into profits. Nissan's move breaks that silent agreement. With these discounts now live across SUVs, compact cars, and even some crossovers, Nissan just forced the entire industry into a corner. Ford, GM, Toyota, every one of them has to decide whether to hold their pricing and risk losing customers, or join Nissan and slash prices to stay competitive. Once one major player dumps inventory with heavy cuts, a price war is almost unavoidable, and that could trigger a massive shakeup across the entire US auto landscape. And Wall Street, the reaction was instant. Investors hate price wars because it means shrinking margins, weaker profits, and pressure on quarterly earnings. Nissan's announcement sent analysts scrambling, questioning whether other automakers will be forced to follow. If Ford or GM get dragged into matching these discounts, that could hit their stock prices hard. Even Toyota and Honda, usually stable, could feel the impact if this pricing battle gets worse. For investors, Nissan's move signals uncertainty, volatility, and a market that could flip from strong pricing power to outright discount chaos. Now the question on everyone's mind: should buyers take advantage of these deals right now? The short answer: if you've been waiting, this might be one of the best windows in years. Nissan's discounts are deep enough to shave off interest costs, trim monthly payments, and save thousands compared to what buyers were paying just months ago. But there's also the risk that even lower prices might be coming if a full-blown discount war breaks out. Buyers have to decide whether to grab the early deals or wait and see if Ford, Hyundai, or Chevy counter with their own price cuts. Competitors are watching Nissan closely, and trust me, they're not calm about it. How do other automakers see this? For Toyota, Hyundai, Honda, and Ford, Nissan's move feels like a direct threat. Each company is now calculating whether Nissan will steal customers over the next few months. Some brands are preparing targeted incentives, while others are bracing for a broader market correction. No automaker wants to start a discount battle, but none can afford to lose buyers either. Nissan's bombshell has basically put pressure on all of them to respond, whether they want to or not. Nissan's strategy goes even deeper when you look at the timing. They didn't just wake up one morning and decide to cut prices. They chose a moment when the industry is extremely vulnerable. High inventory, cautious consumers, and rising competition from cheaper Korean and Chinese brands have created the perfect storm. Nissan wants to position itself as the brand that breaks the affordability barrier first. If they can win back budget-conscious buyers, rebuild showroom traffic, and clear out 2024-2025 stock before 2026 models arrive, they gain valuable momentum that other automakers didn't see coming. This isn't just a discount, it's a calculated attempt to reshape Nissan's image and regain the trust it lost over the past decade. But here's the twist: Nissan is also betting big on psychology. When customers see a major automaker slash prices aggressively, it sends a message. Either this brand is desperate or this is the deal of the year. Nissan is counting on the second reaction. They want headlines, they want buzz, and they want shoppers walking into dealerships saying, "I heard Nissan has insane deals right now." That foot traffic alone can flip a slow market into a feeding frenzy, and if Nissan can do that while competitors hesitate, they gain an edge that money normally can't buy. Dealers, meanwhile, are reacting in two completely different ways. Some Nissan dealers are celebrating, finally seeing a chance to move metal that's been sitting for months. Others are frustrated because deep discounts mean smaller margins and less room to negotiate. But every dealer agrees on one thing: the customer inquiries have jumped. When consumers hear the words massive discounts, they act fast. It doesn't matter if it's a Rogue, an Altima, a Sentra, or a Frontier. Traffic is traffic, and Nissan just lit the fuse. And the ripple effect doesn't stop there. Suppliers connected to Nissan are now wondering how these discounts will affect parts orders, production timelines, and future demand for components. If Nissan's strategy works and sales surge, suppliers will have to scale production quickly. But if it backfires, it could lead to production cuts, layoffs, and even more instability in the automotive supply chain. Nissan didn't just disrupt pricing, they disrupted the entire ecosystem that supports the industry. Financial analysts are warning that if this discount wave spreads, it may reshape the 2025 profit outlook for most automakers. Many companies were hoping to keep prices elevated and ride the wave of high margins for another year. Nissan just ripped that plan apart. If consumers suddenly expect lower prices across the board, automakers may be forced to adjust their strategies, cut marketing budgets, delay new models, or shift focus to cheaper trims. Nissan may have fired the first shot, but everyone else may be forced into the battlefield whether they're ready or not. Another overlooked angle in this story is how Nissan's move might influence leasing trends. Over the past 2 years, leasing became unattractive because monthly payments skyrocketed with elevated MSRPs and high interest rates. But now, with Nissan slashing prices, lease programs are suddenly becoming competitive again. Lower vehicle prices mean lower depreciation calculations, which means lease payments can drop significantly. If Nissan pushes aggressive leasing incentives on top of these discounts, they could pull in thousands of customers who walked away from the market entirely. And if leasing rebounds, that puts even more pressure on competitors who've been struggling to keep their lease offers appealing. And while all of this is unfolding, Wall Street analysts are warning that Nissan's competitors might face downgraded outlooks if they fail to respond. Investors want stability, not price chaos. If Nissan forces the market to shift downward, companies with high production costs or bloated inventories could suffer the most. The fear isn't just lower profits, it's that the entire industry's margins could collapse if discounting becomes the new normal. In a sector already challenged by rising labor costs, EV investments, and global supply uncertainties, pricing pressure is the last thing automakers wanted heading into 2026. But here's where things take an even more dramatic turn. Nissan's discounts are arriving at a moment when consumer confidence is split. On one hand, buyers are more price sensitive than ever. Inflation, high interest rates, and stagnant wages have made big purchases feel risky. On the other hand, people have been waiting years for new car prices to return to something remotely normal. Nissan is tapping directly into that pent-up frustration. Their message is simple: if no one else will lower prices, we will. That bold positioning immediately separates Nissan from automakers who are still clinging to pandemic-level pricing. And this is where the risk becomes massive. If Nissan sells out faster than expected, they could find themselves rebuilding production schedules, rushing orders, and scaling up for demand that other automakers underestimated. But if sales don't spike, if consumers hesitate or think even steeper discounts are coming, Nissan might end up eroding their own pricing power without getting the sales boost they're counting on. It's a gamble, a huge one, and the industry is watching to see whether Nissan's bravery turns into brilliance or backfires. Meanwhile, behind closed doors, marketing departments at rival companies are already crafting counter messages. Toyota could emphasize reliability over discounts. Hyundai could highlight features and tech value. Honda could lean into long-term ownership cost. Ford and GM might focus on American manufacturing pride. Every brand is trying to figure out how to defend its territory without publicly admitting that Nissan just shook the ground beneath their feet. But if enough consumers shift to Nissan in the next few weeks, expect a domino effect of discounts across multiple brands. It won't be optional, it'll be survival. Even auto lenders are recalculating. Banks and credit unions know that lower vehicle prices change everything. Loan-to-value ratios improve, risk drops, monthly payments shrink. That means lenders may loosen approvals, giving more buyers access to financing. If that happens, we could suddenly see a surge in entry-level buyers, first-time drivers, students, and families upgrading from older cars, flooding back into the market. And if Nissan becomes the gateway brand for this wave, it could reshape their customer base for years to come. Supply chain partners, meanwhile, are bracing for turbulence. Tier 1 suppliers that provide engines, transmissions, electronics, and interior components are waiting to see whether Nissan will increase order volumes. This is a huge deal because suppliers rely heavily on forecast stability. If Nissan's strategy throws forecasts into chaos, either rising too fast or falling short, suppliers could face overtime production, bottlenecks, or even idle weeks. Nissan's pricing move may look like a dealership-level event, but it is creating ripple effects that stretch all the way to factories overseas. And the dealership battlefield is shifting rapidly too. Sales managers are already preparing scripts to explain these offers to customers walking through the door. Warranty add-ons, extended service plans, accessories. Dealers are calculating how to make back the revenue they lose from lower vehicle prices. Some are planning volume-based strategies, some are focusing on financing upsells, but everyone agrees on one thing: foot traffic is king, and Nissan's discounts are driving it hard. Another dimension that's rapidly emerging is the impact on regional markets. Nissan's discounts aren't hitting all areas equally. States with historically slower Nissan sales are seeing the steepest cuts. This is intentional. Nissan wants to reclaim territory in regions dominated by Toyota in the West, by Ford and Chevy in the Midwest, and by Hyundai and Kia in the Southeast. By aggressively lowering prices in these zones, Nissan is trying to break long-standing customer loyalties. If even a small percentage of buyers switch brands because of these deals, Nissan gains ground that would normally take years to win back. Competitors know this, and that's why their regional managers are now scrambling to prepare counteroffers in their strongest markets. Meanwhile, consumer behavior data is already shifting. Search traffic for Nissan models is spiking across Google, AutoTrader, Cars.com, and dealership websites. More shoppers are comparing the Rogue against the RAV4, the Altima against the Camry, and the Frontier against the Tacoma. Because now, for the first time in years, the price advantage is undeniably in Nissan's favor. When customers start actively cross-shopping instead of staying loyal to a brand, the playing field changes fast. Nissan is hoping to convert that curiosity into sales before competitors strike back. And here's where things get even more interesting. Fleet buyers are paying attention. Rental companies, small businesses, and corporate fleets are always hunting for cost-effective vehicles. Nissan's deep cuts make their models extremely attractive for bulk purchases. If fleets start placing large orders, Nissan could see a major uptick in sales that boosts production forecasts and improves factory utilization. That's a huge win because fleets often buy hundreds or thousands of vehicles at once. If Nissan secures even a few big fleet deals, it could push the brand back into stronger quarterly numbers and reverse its recent downward trend. But there's a downside. Fleet-heavy sales can hurt resale values, which is something Nissan has struggled with before. If too many vehicles flood into rental lots and corporate fleets, used prices fall faster, which could reinforce Nissan's reputation for heavy depreciation. This is the tightrope Nissan is walking: short-term sales boosts versus long-term brand value. The next 90 days will show whether they can manage that balance or if they'll need another strategy shift later this year. Buyers, meanwhile, are trying to make sense of the timing. Some consumers are wondering whether now is the moment to move, or if even deeper discounts might appear during the next quarter. That uncertainty is something Nissan hoped to avoid, but once a major discount hits the market, customers start anticipating more. This mindset can delay purchases if buyers believe prices will fall again. Nissan's challenge now is to create enough urgency, limited time, limited stock, limited allocations, to convince shoppers that these deals won't last long. If customers believe the discounts are temporary, Nissan wins big. If they think the discounts are the new normal, it becomes harder to close deals quickly. Across the industry, analysts are warning that this could become a blueprint. If Nissan succeeds, other automakers may adopt the same approach: aggressive discounting to regain market share, maintain factory volume, and generate headlines. This could fundamentally shift how cars are priced in America. Instead of steady MSRPs and controlled incentives, we might move into a market where volatility is normal, where discounts spike and fall every quarter, and where no automaker can rely on stable pricing for long. Nissan has essentially thrown a wrench into the pricing structure that US buyers have been dealing with for nearly a decade. And while the industry scrambles to understand Nissan's bold strategy, one group is unusually quiet: EV manufacturers. That silence isn't accidental. Nissan's move to slash prices on gas-powered models comes at a moment when EV demand is softening nationwide. High prices, charging concerns, rising insurance costs, and slowing incentives have caused EV inventory to pile up in many regions. By dropping prices on their combustion lineup, Nissan is effectively pulling attention and customers away from electric competitors. Tesla, Rivian, and even Ford's EV division now face a new challenge, convincing buyers that paying a premium for an EV still makes sense when gasoline cars are suddenly far cheaper. If Nissan's strategy sparks a broader discount wave across traditional gas vehicles, EVs could face even more pressure. A buyer looking at a $38,000 EV might suddenly switch to a $26,000 discounted crossover without thinking twice. That's a major shift in buyer psychology, and EV makers know it. We may soon see EV-specific incentives or new price cuts as these companies fight to stay competitive in a landscape that's suddenly being reshaped by Nissan's bombshell move. Meanwhile, financial institutions tracking auto loans are already adjusting risk models. Lower prices generally reduce loan defaults because borrowers owe less relative to the value of their car. If Nissan's discounts lead to higher sales of affordable vehicles, lenders may actually benefit: lower default rates, more loan approvals, and better repayment performance. But the ripple effect hits automakers in the opposite direction. Lower prices mean lower revenue, and lenders are watching closely to see how that imbalance plays out. If Nissan can drive enough volume to offset those lower margins, things stabilize. If not, it becomes a profitability headache that competitors will want to avoid. For Nissan owners, this development brings mixed emotions. On one hand, cheaper new models mean the brand is becoming competitive and popular again. On the other hand, heavy discounts can reduce the resale value of current Nissan vehicles. But many Nissan owners are used to this cycle. The brand has historically offered stronger incentives than Toyota or Honda. The difference now is the scale. This discount wave is far larger and more aggressive than the usual seasonal promotions. Some current owners may feel frustrated, while others may see this as an opportunity to trade up at a better price. Inside Nissan's corporate offices, executives are watching early sales data like hawks. Day-by-day traffic numbers, lead conversions, dealership feedback, and regional performance maps are being analyzed constantly. If certain models respond well to the discounts, Nissan could expand the program. If some models don't move, even with price cuts, Nissan may have to rethink production, marketing, or even model availability. This isn't just a discount, it's a real-time stress test for Nissan's lineup. And competitors know it. Executives at Ford, Toyota, Hyundai, GM, and Honda are monitoring Nissan's every move. If Nissan clears inventory at record speed, they'll have no choice but to join the price war. If it fizzles, they will use that outcome to justify keeping their prices high. Right now, every automaker is waiting for the same data. Does Nissan's gamble ignite a sales surge, or does it fall flat? And as the data begins to trickle in, one trend is already becoming clear. Consumer response is stronger than Nissan expected. Early dealership reports show rising foot traffic, faster test drive scheduling, and increasing weekend showroom activity. This proves one thing loud and clear: Americans have been waiting for relief. They've been waiting for a brand to finally say, "We hear you, prices are too high," and Nissan is the first major automaker willing to take that risk. That willingness is now paying off in attention, curiosity, and momentum. But here's the bigger picture. The US auto market has been stuck for years in a cycle of rising prices, shrinking options, and frustrated buyers. Nissan's bombshell discounts may be the spark that breaks that cycle. If competition forces prices down across the board, buyers win. If dealerships regain foot traffic, the industry grows healthier. But if a full-blown price war emerges, automakers could see profits tighten and strategies rewritten. This is the delicate balance Nissan has now forced everyone to confront. For Wall Street, the message is complicated. Investors fear margin erosion, but they also love volume and market share. If Nissan's aggressive move boosts Q1 sales dramatically, analysts may revise their expectations upward. But if other automakers are dragged into the discount arena, expect volatility, and lots of it. Stocks connected to companies with higher manufacturing costs could dip, while those with leaner operations might benefit from the renewed competition. This is why financial analysts are calling Nissan's decision a moment of recalibration for the entire auto sector. As for buyers, the window of opportunity is wide open. Nissan has effectively created one of the most buyer-friendly environments in years. If you've been waiting for a new SUV, sedan, or pickup without breaking the bank, these discounts are undeniably appealing. But the smartest move depends on your timing. If other brands follow Nissan in the coming weeks, prices could drop even further for certain models. If they don't, Nissan's deals may turn out to be the best you'll see for a long time. Either way, the next 60 to 90 days will be the the most dynamic car buying environment we've seen since the pandemic. And how do Nissan's competitors see this? In one word, pressure. Every major automaker is now forced to reevaluate pricing, incentives, and inventory strategies. Some will hold firm, some will quietly roll out bonuses, and some, especially those with oversupply, may be pushed into matching Nissan publicly. The auto industry doesn't like disruption, but Nissan has guaranteed that the next few months will be unpredictable, fast-moving, and potentially transformative. In the end, Nissan's massive price drops are more than a discount. This is a statement, a challenge, a battle cry signaling the start of a new era where automakers can no longer rely on elevated prices and unquestioned demand. Nissan has taken the first step, and the industry must respond. Whether this leads to healthier competition or a brutal price war is still uncertain, but one thing is guaranteed: the US auto market will not look the same after this, and that is the impact of Nissan's bombshell on prices, the auto industry, Wall Street, competitors, and buyers across America.